Hello, welcome to the Chapter 4 lecture. So, we're going to be talking about the accounting cycle in Chapter 4. Chapter 4 pretty much picks up where Chapter 3 left off after the adjusting entries. So, we've finished the adjusting entries that were introduced in Chapter 3. Now it's time to consider closing the accounting cycle. So, once the adjusting entries have been completed, the next step typically is to prepare what's called an adjusted trial balance. So what I've got here, and hopefully you can make most of this out. Make it just a little bit larger. So what you have here is an adjusted trial balance here in the middle. So there's the unadjusted trial balance. We record the adjustments from chapter 3, and then we have our adjusted trial balance. And this adjusted trial balance is what we now use to complete the accounting cycle. And when we complete the accounting cycle, well, we prepare financial statements. We prepare the income statement. That's what you see here. We prepare the balance sheet. That's what you see here. And we also prepare the statement of stockholders' equity. And sometimes there's also a statement of cash flows prepared, but we're not going to look at that in this chapter. The income statement, we'll look at several income statements, and we've looked at the income statement before. We did that in chapter 1. The income statement fundamentally is a very simple statement. It is just the revenues, the expenses, and the difference is what we call our net income. That's what the income statement is. The balance sheet, on the other hand, is everything that you see on the basic accounting equation. Is the assets, the liabilities, and the equity. And we tend to call these the financial statement elements. And then the stockholders' equity statement, which shows a summary of the activity in stockholders' equity. So we see the common stock starting point and any additions. We see the retained earnings. It's the starting balance plus any income minus the dividends and the net of the two, right? When we sum these two together, we end up with the ending balances in stockholders' equity. And within stockholders' equity on the balance sheet, we are reporting on two things. We're reporting on the common stock and we're reporting on the retained earnings. That's all that you're going to see on the balance sheet in stockholders' equity, common stock and retained earnings. So this chapter really starts out with preparing those financial statements. We prepare this post adjustment trial balance. So it's called an adjusted trial balance because it's after the adjustments. After we've prepared and posted all of the adjusting entries, we prepare a trial balance, and then from that trial balance, we can prepare these financial statements. And let me see if I can make this a little bit smaller now. So again, the basic financial statements are the income statement, the statement of stockholders' equity, and in addition to those financial statements, the other thing that we're going to look at in this chapter are what we call closing entries. Closing entries are necessary to close certain accounts. Basically, the accounts that we use during the period consist of permanent accounts or the real accounts and what we call the temporary accounts or the nominal accounts. So what do these terms mean? Well, permanent accounts are those accounts that have balances that are carried over from year to year. And basically all the permanent accounts are all the accounts that you see on the balance sheet, all of the assets, all of the liabilities, and the two equity accounts, common stock and retained earnings. So the permanent accounts are accounts that we determine the ending balance, and then the ending balance gets reported on the balance sheet as either an asset, a liability, or stockholders' equity. That was supposed to be stockholders' equity or kind of an SE. That's what that was supposed to be. Sorry about that. Stockholders' equity. So the permanent accounts are the sometimes called the real accounts, the accounts that carry over to assets, liabilities, and stockholders' equity. On the other hand, we also have some temporary accounts. We have some temporary accounts that we use during the period that ultimately we have to close out to the stockholders' equity. So the temporary accounts there are three of them. There are the revenue accounts. So revenue is a temporary account. It's an account that we use just to accumulate revenue during the period, and then we close it out at the end of the period. The expenses. Expenses are temporary accounts. We use them only to accumulate expenses during the period. At the end of the period, we close them out. And then we also have the dividends account. The dividends account is only used during the period to accumulate the distribution of dividends, and then we close it out at the end of the period. So the permanent accounts, assets, liabilities, and the two stockholders' equity account, common stock and retained earnings, get carried over from year to year. But the temporary accounts, revenues, expenses, and dividends, those accounts we have to close out after all those adjusting entries have been completed. We want to close out all of those temporary accounts. So let's continue on and talk about these closing entries. How do we close those temporary accounts? We do it in a two-step process. So the first step is to close the revenue and expense accounts. Those accounts have to be closed, and then we close the dividends account, and everything gets closed out to the retained earnings account, because retained earnings, by definition, is the retention of earnings minus dividends. So the revenue and expenses and the dividends get closed out to the retained earnings account. And we do it in two entries. It's a two-step process, and we do it with two entries. The first entry is to close revenue and expenses. The second entry is to close the dividends account. This is kind of an example of what the closing entries look like. The first entry is to close the revenue and expenses account. Now, what do we mean when we say close the account? It means we want to zero out the balance. So, for example, if we have a revenue account, and revenue accounts, well, they typically will have a credit balance. On the other hand, expenses will typically have a debit balance. So we have expenses that will typically have a debit balance. And lastly, we have dividends, which will typically have a debit balance as well. Those are the three temporary or nominal accounts that have to be closed. And I've identified here and noted the normal balances in those accounts. So if we want to close the account out, that means we want to zero the account. The only way you can create a zero balance in a revenue account is by debiting it for whatever the credit balance is. And then you end up with zero. The only way you can close out the expense account, which normally has a debit balance, is to credit it. And that's how you create a zero balance. The only way you can close out the dividends account, which normally has a debit balance, is to credit it. And that's how you would create a zero balance. Well, that's all we're doing here. The revenue account fees earned has a credit balance of 16,840. So to close it out, we're going to debit it for 16,840. And there's two revenue accounts. Doesn't matter how many you have, you're going to do the same thing to both of them or all of them. You're going to debit the revenue accounts. The expense accounts normally have debit balances, so to close them, we credit them, right? So the closing entry is just the opposite of the normal balance. So revenue accounts normally have a credit balance. To close them, we debit them. Expense accounts normally have a debit balance. To close them, we credit them. Dividends normally has a debit balance. To close dividends, we credit it. So we have debits to the two revenue accounts. We have credits to all of the expenses. That's what we've done. We have debited the revenue and we have credited the expenses. And the difference because there's a difference between the revenue and the expenses. That difference is income. That difference, we credit the retained earnings account. We close all of these accounts out to retained earnings. And we do the same thing with dividends. Dividends normally has a debit balance, so we credit it, and we also close that account by debiting retained earnings. Those are the two closing entries that we need to close those temporary accounts. And I'll end with an example that we'll actually work through so that you can see how the numbers come together. But that's our process. So we've talked about basically two things in this chapter. One, preparing financial statements. At the end of the period, the close to the accounting cycle consists of one, preparing those financial statements, and two, preparing the closing entries to close those temporary accounts. Let's move now to the illustration problem that I have for you. That's right here. So this is the illustration problem. So in this illustration problem, I want to do the two things that I just talked about. One, prepare financial statements, and two, close the accounts. So if we're going to prepare financial statements, that means that we're going to use the adjusted trial balance. Everything that we need to prepare financial statements comes from the adjusted trial balance. That's what we have after the end of chapter 3. After all the adjusting entries have been posted, we have an adjusted trial balance. And what we want to be able to do on this adjusted trial balance is identify the items that we need for our financial statements. Well, the first financial statement that we need is the income statement. That's number one. Well, the income statement is just revenues and expenses. That's all it is. That's all we're doing on an income statement is we are summarizing the revenues and the expenses. Well, fees earned is our revenue, and salaries expense, well, that's our expense. I'm keeping it simple here so that in this illustration, there's only one revenue, there's only one expense. That's all we need on that income statement, the one revenue and the one expense. So now when we put this income statement together, title of the statement, it's for the month ended January 31. We need our revenue here, fees earned. So we've got fees earned that are how much? Fees earned right here, I've identified 50,000. So we've got $50,000 of fees earned. And then we need expenses. Well, we only have one expense, salaries expense. So we have the salaries expense. How much are the salaries? Well, the salaries are $25,000. So $25,000. And our net income, it's the difference between the two, right? 50,000 minus 25,000 is $25,000 of income. And that's our income statement, right? That's it. So the income statement, it doesn't matter how many revenue accounts we have or how many expense accounts we have. All the revenues would be listed here in the revenue section, and all of the expenses would be listed in the expense section. Take the difference between the two, and we've got our income. That's all we're doing on an income statement. That's number one. That's our first financial statement. Next is retained earnings. Well, on this retained earnings statement, all I'm going to do is summarize the activity in retained earnings. So typically in retained earnings, we we basically do two things. One, we start with the beginning balance in retained earnings, and then we add in and subtract out whatever the activity is in retained earnings for the period. And there are only two things that are going to go into that retained earnings account: income or loss and the dividends. Income or loss and the dividends. So in this case, we want to start with whatever the beginning balance is in retained earnings. So let me identify here that we have retained earnings of 45,000. And let me note here that this is the beginning balance in retained earnings. It's the beginning balance. $45,000 is what we start with in retained earnings. And that's what we use on this income, on this retained earnings statement. A retained earnings balance at the beginning of the year, January 1, 2023, that balance of $45,000. Put that here. And then we just want to add in the income. How much income? Well, it's right there. The income comes from the income statement. So we've got $25,000 of income that comes from the income statement. And then we want to subtract out the dividends. And how much are those? Well, the dividends are 10,000. They're right there. So we want to subtract out the dividends. Got to subtract the dividends. And 25,000 minus 10,000 gives us $15,000 of dividends. That's our retained earnings. That's the change in retained earnings. So 45,000 plus an increase of 15,000 means that we're ending the period with a retained earnings balance of $60,000. That's our retained earnings at the end of the period. So that's what we're going to need on our balance sheet. So there are two things that are really important here so far. One is we've established that we have the income of 25,000 and we use that income here on the retained earnings statement. And two, this balance in retained earnings. Now this is the ending balance in retained earnings. Again, this is what goes on the balance sheet, that $60,000. So now we need to prepare that balance sheet for this firm. That's the next step here. So if I could scroll up here, we want a balance sheet. Number 3 is the balance sheet. So 1 is the income statement, 2 is retained earnings, and 3 is the balance sheet. And then the last thing 4 will be the closing entries. So on our balance sheet. So on our balance sheet, now in this chapter, we are introducing what we call a classified balance sheet. What that means is typically assets have two categories. They're current assets and they're non-current assets. Current assets are assets that we consume within a year. Non-current assets we don't consume within a year. And the current assets are things like cash and receivables and prepaids and supplies. And then we have sometimes we'll have those non-current assets as well. And same thing for liabilities. We typically have two kinds of liabilities. We have those current liabilities like accounts payable, and then we might have long-term liabilities like a mortgage, for example, or bonds. And then we have stockholders' equity. And in this problem, though, I'm just giving you some basic items for the balance sheet, and I'm not distinguishing between current and non-current. We'll do that a little bit later. But for now, we just have cash and receivables and supplies. Those are the assets. So again, I'm going to start by identifying the key items that we're going to need in this balance sheet, because remember, the balance sheet is based on the accounting equation. The balance sheet is based on all the assets being equal to the liabilities plus the equity, the stockholders' equity. So we have here all of the assets. These three right here, well, those are assets. And there's only one liability, accounts payable. And then we're going to need equity. And there are two equity accounts that go on the balance sheet. So the stockholders' equity consists of common stock and retained earnings. And we're going to need common stock and the ending balance in retained earnings. But those are the items that are going to go on that balance sheet: assets, liabilities, equity, the permanent accounts, right? All of these accounts are the permanent accounts. All of the accounts on the income statement are the temporary accounts. So on this balance sheet, let me see if I can complete this. So on this balance sheet in the asset section, we're going to need cash. And the cash, well, the cash is, let's see, 110,000. And then we need the receivables and the supplies. And I'm going to try to remember what those amounts are so that I can type them in without having to scroll back up. So we've got cash of 110,000. We've got accounts receivable. 50,000, if I remember correctly. We've got supplies. And supplies, I believe, were 20,000. Let's make sure I got everything that I did. Sorry, I didn't mean to do that. Okay, so let's make sure I got everything. Cash, accounts receivable, and supplies. Yeah, got them. 110, 50, and 20. And then we have a total, right? We don't have any other assets. We only have those three. So let's kind of call this our total assets. Right? Total assets, the sum of those three, that's $180,000. So we have $180,000 for all of these assets. And then there's only one liability. And the only liability is the one identified, accounts payable for $20,000. So under liabilities, we've got accounts payable. And again, accounts payable is $20,000. And then under stockholders' equity, remember, we only have two divisions. We have common stock and retained earnings. And the common stock is 100,000 and the retained earnings is 60,000, that ending balance that we get from our statement. So let's put those two in here. So under stockholders' equity, we've got common stock. And again, that's 100,000. And then we also have the retained earnings, which was the 60,000 from our retained earnings statement. And now when you put these two together, that means that the total stockholders' equity, the sum of the two, is 160,000. And if we put in a total here, total liabilities, stock equity, I'm going to abbreviate that. Total liabilities and stock equity is 180,000, right? The 20 of accounts payable and the 160 of total stockholders' equity gives us 180,000. And I didn't label this. Let me just go ahead and label this. This is the total stock equity. That's what that 160 represents. It is the total stock equity. So again, this mirrors the basic accounting equation. All the assets, cash, accounts receivable, and supplies is 180. Liabilities are 20. Equities 160. The assets just equal the liabilities plus the equity. So again, two things in this chapter we're focused on: preparing financial statements, and we just did three of them, right? We just did the income statement, which is revenues minus expenses. We did the retained earnings statement, which is beginning balance plus income. If it was a loss, we'd subtract the loss minus the dividends. And now we did the balance sheet, assets, liabilities, and equity. And then the last step here, number 4, we need closing entries. We need closing entries, and actually there are going to be 2 closing entries, not 4. So let me just kind of X this out, because there are 2 closing entries that we're going to use. I've condensed them into 2 instead of 4. We're going to journalize with 2 required closing entries. So the 2 closing entries that we need, again, the first step is to close the revenue and the expense. And we know what those are because I've identified them, right? There's one revenue and there's one expense. We're going to close those. And then we're going to close the dividends. So the first step is to close the revenue and the expense. The second step is to close the dividends. Revenue has a credit balance of 50,000. Expense has a debit balance of 25,000. So when we close these accounts, we want to zero them out. That means that we have a revenue account that has a credit balance of 50,000. To close it out, we're going to have to debit it. So we're going to debit that fees earned account. fees earned, we're going to debit it for the balance of 50,000. And then that salaries expense has a debit balance of 25,000. To close it out, we're going to credit it. So we're going to credit that salaries expense for 25,000. And now we've got to balance this entry because remember, for every entry, the debits have to just equal the credits. So we need something else over here on the credit side because we've got a debit for 50, but we only have one credit for 25. What else do we need? The thing that we're always going to need in this entry is retained earnings. So retained earnings needs to be the difference between the 50 and the 25. So what we have here is we have $50,000 of revenue, and we want to subtract out the $25,000 of expenses. And what that will leave us with is $25,000 that needs to go here into retained earnings. Right? So we always want to make sure we take the difference between what we've closed out in revenue and what we've closed out in expenses. And it's that difference that goes here that gets adjusted into that, not adjusted, but gets closed into that retained earnings account. Now, if we had more expenses than we did revenue, we'd be debiting the revenue account. And you'll see that on one or two of the homework problems. But here we've got income. And when there's income, we'll be crediting retained earnings. Okay? And then that second step is to close the dividends account. Now, dividends has a debit balance. To close it, we're going to have to credit it. And the offsetting item in that entry is retained earnings. So we have dividends that has a balance of 10,000. We'll be crediting dividends. And if we credit dividends, again, what that means is we should be debiting retained earnings. So the retained earnings needs to be debited for 10,000, and the dividends account needs to be credited for 10,000. And that's the second step or the second closing entry. So every time we close the accounts, again, the first step is to close the revenue and the expense accounts and close them out to retained earnings. The second step is to close dividends, and we close dividends out to retained earnings. And that's it. Those are the two things that we're going to be looking at in chapter 4. And I'll see you for the problems that we'll be looking at next.